Welcome to Enterprise Design's Industry Insights, where we identify key topics in the commercial real estate industry. I'm Ann Weston, Director of Design Services.
And I'm Jessica Green, Director of Client Services. For this series, we're discussing market trends with Dallas-based commercial real estate professionals.
So today we're here with Dixon Rich and Patrick Andal with C3 Partners. Thank you guys so much for being here.
Thanks for having us. Appreciate being here.
Yes, thank you all for being here.
So our first question, we want to do something a little personal. I hope that's okay. We want to know a little bit about you guys. So can you tell us about your role at C3 Capital Partners, how long you've been in the industry, and how you came to your current role?
Patrick, you want to go ahead?
Absolutely. So I've been working at C3 for the past 4 years. I work with Dixon Rich in our asset management group. I started my career off as an accountant. I describe myself as a recovering accountant. A lot of people I've found in Dallas have taken a similar route, but my experience was in the auditing realm. I worked for KPMG for a couple of years. I had a brief stint at Deloitte where I did real estate valuation and found myself in working with Dixon shortly thereafter in the asset management realm.
Yeah, at C3, I've been in the asset management group for probably 12 years. Before that, I was at Fortress Investment and Transwestern and Goldman Sachs and Trammell Crow. So I've been at several firms. All of them have been great experiences. Not all of them in asset management. I started out my career with Trammell Crow Company doing development, then also did development at Goldman and at Transwestern. And then during the great financial crisis, I was on my own briefly, but then went to work for Fortress, and then after that, C3. Primarily, we handled asset management of office buildings and also some other commercial projects like retail and some industrial at C3. But primarily, C3 does primarily multifamily and office.
Awesome. So tell me, what keeps you both in this industry and why do you stay in it?
Well, probably 5 years ago, I would have said 5 kids through college. I don't have that issue anymore. No, seriously, it's a very interesting industry. There were a lot of people. If you look at the demographics of the industry, there were a lot of people that were in my age group, baby boomers that came in kind of during the 80s, and then we had a huge dip. And so today, if you look at I think somebody told me once that the demographics, the oldest were farmers, and if you look at the demographics of workers, the oldest were farmers, the second oldest were auto workers, and the third was commercial real estate, which surprised me. It surprised me a lot. So there's a lot of old guys like me that are probably going to retire in the next 5 or 10 years. That's probably an issue that the industry is going to have to face. But what keeps me here is that obviously it's variety. It's the newness. Every deal is different. Even when I've come across it's funny, in this job I've come across a couple of deals that I worked on 15, 20 years ago, and they're different now than they were when we bought them or invested in them the first time. So.
And for me, having started off my career in a slightly different profession, having a tangible asset that's impactful in any given community is what attracts me. Anytime you drive down the street, your views are full of real estate. And specifically working in asset management, the idea of executing a business plan from taking something, specifically we deal in the value add spectrum of risk in real estate. And so taking something that needs deferred maintenance or is in some distress situation and improving it and ultimately seeing it sold as a better product. For me, that's something that brings a lot of fulfillment.
That's great. I love that you have a passion about it, that you're really wanting to take something and make it better. That's always been my passion with design, especially in corporate office, that you really are affecting people's mindsets and where they go every day and the things that they experience. If you can do that within the design of their office space, hopefully that gives them a better quality of life. And at the end of the day, it just makes their overall experience better. So then, Dixon, what are the biggest differences between the Dallas market and other markets nationwide for office buildings?
Well, we're actually in a very fortunate position where we get to operate in several markets. So I think we have a good perspective on that. I'd say in Dallas, probably too many good developers, and it's too easy to build. Okay, but that does have a plus side, and that is when you're looking for product that's the creativity, new ideas, et cetera. This is a good breeding ground for those new ideas. I'd say too that in Dallas, fortunately or unfortunately, the business community here is very entrepreneurial and is comfortable with taking risks. What that does is, though, it drives down returns on investments. So what we typically, and also, there's not a lot of barriers to entry. If you go to coastal cities or maybe even some interior cities that have some topography, some barriers, there's more barriers to entry. That can come in the form of natural barriers like an ocean or a mountain range. It can come in the form of governmental regulation, zoning, like in California you have CEQA, which is the environmental impact. And so in Dallas, you really don't have any of those. You don't have any natural barriers. Government is not obtrusive like it is in some other markets like California or even Austin. And so as a result of that, though, that doesn't always make for the best investments. It makes it easier if you're a developer to develop new buildings. So,
Patrick, do you have anything to add or other perspectives?
I think you covered it. Yeah.
That's very interesting. I'm always glad to hear what's happening in other markets. I worked quite a bit in other markets, and it's always kind of been a wide spectrum. So it's really nice to just hear some of the perspectives that you have. I think one of the things that I just didn't realize is that there are no real barriers here. Obviously, it's very flat in Texas, so people can just keep building and going beyond Dallas. I think Sherman is soon to become a suburb of Dallas. But really, there's no governmental restrictions, like
Right.
Obviously places like California that have a lot of that. But it's very interesting to hear that Dallas is just kind of what everybody wants to do. And it's really just going to keep growing. And I feel very blessed to be here. And that there's always going to be that work. We've recovered very well from 2020, but it's always great to hear what else is going on, across the nation.
well, you also have to have for that to sustain itself, you also have to have, high demand. Otherwise, the buildings, if you build more buildings, then they're going to be empty. Okay, at least here in Dallas, they get leased, but maybe the returns you achieve on that investment may not be as high as if you're saying Boston or California or Austin, where there's barriers to entry. When you're creating 100, 120 to 130,000 jobs a year, that helps fill those buildings.
Right, exactly. I think also it increases creativity as well. The builders here, because you're kind of competing for the next best thing, and how you don't have any barriers to entry, so that makes it even extremely more competitive in that aspect. And as far as an investment standpoint, that can be extremely tricky as far as it sometimes returns.
Yeah, it's like Warren Buffett says, you like to invest in things where there's a moat around your investment, some kind of barrier to entry. And in Dallas, there's a lot fewer barriers to entry than there are in some other markets.
Well, Patrick, I'll leave this one over to you. What resources do you use to assist remote owners to understand the market sector in Dallas?
It's a great question. I have somewhat of a hybrid role at C3. On top of the asset management work I do with Dixon, I also assist the acquisitions team, which happens to sit in New York. And so when we're looking at Dallas product, that's a very important question. As opposed to a lot of other investment sectors, real estate is very much relationship focused. There is software that helps to understand a market remotely. But really, boots on the ground still is very important in relationships with leasing brokers, investment sales brokers, who are on the ground in the market that you're looking at, doing the day-to-day work. It still is the most effective way, in my mind, in my experience, to understand the nuances of any given market or submarket.
Well, and to add on to that, how have higher interest rates affected deals for commercial real estate properties? Have you seen some of where it becomes an issue?
Certainly are less active. A lot of deals just don't pencil out. On the office realm, I'm sure Dixon would agree, there's still a bid-ask spread between what a buyer and seller think a given property is worth. And to support today's pricing and to take on debt at the current levels where we're at, that brings negative leverage. And the only way that pencils out is if you continue to think that rent growth is going to beat out or continue at a pace that we've seen over the last couple of years, particularly on the multifamily side, which is unsustainable.
Yeah, those prices and those rent rates are really going very high. We're seeing, things double, even triple within a few months, which has just been a little crazy lately.
Right. Look, I think there's no doubt that higher interest rates have impacted all property types. You can't have the government, what the government charges on a bond or whatever is kind of the base interest, the base rate that most capital is priced on, whether you're talking about debt or equity. And so when that price doubles or triples or goes from, essentially 0 to today 4 or 5% on just the baseline rate, the cost of all the other capital has to change. Now, maybe it doesn't change as much, but it goes up as well. So I think today you're seeing that equity is higher priced, debt is higher priced. But I think unlike most other market down cycles that I've seen in my career, debt is really, the lack of debt or the price of debt has really driven things. Equity's still there, and the price of equity hasn't changed nearly as much on a percentage basis, but it has gone up. And I think because I think the perceived risk in many investments has gone up. Maybe not in multifamily, maybe not in industrial. Those are still very looked on very favorably by the investment community. The risk profile, I don't think the investment community has changed other than the risk of the general market risk, the prospects of a recession. But I think office is a little bit different than all the rest this time around. And I think what we're seeing is something very much akin to what we saw in retail 10 or 12 or 15, starting 15 years ago with the introduction or with the penetration of Amazon and online retailing, and that eroded retail as the retail real estate. And so I think you're seeing some of the same things happen to office, where this is not just a cycle that we're going through. This is a structural change in office that we're still figuring out what that means.
So speaking of investments, are you seeing more investments from private equity firms, or where are you seeing?
Many people would classify us as a private equity firm. So I think they're on the sidelines today because the bid-ask spread between buyer and seller is still wide, very wide. And when those two are going to meet, I don't know. That's one issue. The second issue is for a private equity firm, typically to make your numbers work, you need to have debt at a reasonable level and at a reasonable price. And today, the prices don't reflect where we can get debt. I mean, if you can get debt at all. Quite honestly, on an office investment, you can't find a loan. And unfortunately, banks don't price loans as if in a way that says, well, this isn't our ideal deal. We'll because it's less than ideal, we'll just charge you a higher interest rate. It's really not how banks work. It's either we like it, we do it, and they price it accordingly, or we don't like it, we're not going to do it at all. And today in office, I don't know of any banks that are doing any kind of new office or office loans to speak of. There's probably a few out there. I'm making a blanket statement, but there's very, very few. Yeah. And so I would say private equity firms, as it relates to office, they're on the sideline. As it relates to obviously multifamily and industrial, they're probably trying to find investments. The problem is that the numbers probably don't work as well because now you've had the cost of debt go from 1 or 2% on variable rate debt to today it's going to be 7 or 8%, and that's an adjustment, and I don't think the market's adjusted to that yet for most product.
Do you think it'll adjust?
markets always adjust. It's a question of how long and to what level, you know. Look, I think they'll adjust. You know, it's going to be interesting because you've also had this element of the cost of new construction, which tends to drive things, has gone up dramatically. And so before, you know, over the last several years, while you had maybe the cost of construction going up in small increments, obviously not as much as post-pandemic, but in small increments, that was more than compensated for by the cost of capital was actually going down because, you know, interest rates were going down and the amount of debt you could get was going down. So, you know, you really had prices in terms of rents, in terms of rents primarily, not going up as much. Now you have everything really going the other way. And I think the consumer is still at the point where by consumer, I mean those who rent industrial or office or retail space or multifamily are trying to adjust to that. And there's no way right now, I mean, rents had already gone up quite a bit. Now all of a sudden you're going to layer on the cost of construction going up, and it will just take multifamily because that's very high demand. Now you're going to take the cost of construction is higher, and now your cost of capital is higher. So both things are working in the same direction, and I don't think renters are probably in a position where, you know, they can handle that and adjust to that, because I think already rents are, if you look across the country, they've gone from where they're maybe 25 to 30% of income to where today they're 40 to 45 to over 50% in some areas. And that's, you know, as they say, trees don't grow to the sky. I mean, eventually you hit a limit that the consumer, you know, or businesses can handle. And I think, you know, we're a lot further away from that in industrial, but in multifamily, you know, I mean, how much farther can you go than when somebody's paying 50, 60% of their income in rent?
Right.
Absolutely.
And I think there's already a big issue, especially in Dallas and, you know, specifically in downtown Dallas, of affordable housing.
Right.
That, you know, how are we solving that issue? So, you know, things just keep going up, you know, the ability to have affordable housing is just kind of falling by the wayside. And there's just no way to recoup that. And I do see that's going to be a really big issue here in Dallas.
I do think, though, one difference between Dallas and California, I think in Dallas, there's less of a what I call a NIMBY attitude. In California, while you have people that they want to have affordable housing, they just don't want to have it in their neighborhood. And there's a lot of that in California. Here, and I've been involved in housing in some places, not to pick on people from Pasadena, but that's an area I'm familiar with many years ago. Okay, so it may have changed, but I doubt it. Where, you know, people were all in favor of moderate or low-income housing, they just didn't want to have it in their neighborhood. I mean, look, I think there's some of that, some NIMBYism everywhere you go. My sense is that there's less of that here in Dallas, and so I think that you know will hopefully provide an easier path to find a solution for moderate income housing.
Thank you for tuning in to Enterprise Design's Industry Insights video podcast. Please follow us and subscribe to our channel or visit us on our website at enterprisedesign.com.
And look for our teaser video highlighting the next episode. We look forward to seeing you then.